Ever pondered the allure of tangible assets such as gold, real estate, or fine art? This intriguing question has sparked countless debates and conversations among both financial savants and novices. As their name implies, these are physical entities that you can touch, see, and feel, as concrete as the morning sun or the evening moon. Picture gold bars safely tucked away in a vault, skyscrapers punctuating city skylines, vintage cars that highlight classic auto shows, or invaluable fine art adorning the home of an enthusiast. Many find charm in their inherent value. They're not mere pieces or digital entries on a computer screen at the mercy market fluctuations. When investing, it's in something substantial, real. Moreover, they are often seen as a safety net against inflation. In an economy where worth of currency steadily diminishes, these offer a semblance of stability. They can serve as a barrier to the corrosive effects of inflation, maintaining the purchasing power of your wealth. There's also a sense of security attached to ownership. It's the reassurance that no matter what happens, there's something of value to lean on. It's tranquility stemming from knowledge that wealth isn't just a figure on a screen, but solid and tangible. But like everything else in life, investing with its share of challenges. It's not always plain sailing, bringing its fair share of risks and uncertainties. This brings us to a tantalizing question. Are they a prudent investment or a potential liability cloaked in allure? As we delve further into this subject, aim to shed some light on this query, providing insights and viewpoints to aid in navigating the thrilling world of asset investing. An enduring discourse among financial aficionados revolves around the merits of sinking capital into tangible assets. At the heart of this discourse, two main points are constantly in contention: the stability and security inherent in tangible assets and the potential challenges they present, including illiquidity, upkeep costs, and value volatility. Let's begin by examining the first side of this discourse. Advocates for tangible assets frequently underscore the security that these investments provide. Picture yourself as a landowner. No matter the financial weather, that plot of land will always carry some inherent value. It won't simply vanish into thin air. This is the level of steadfastness and assurance that tangible assets lend to investors. Furthermore, tangible commodities such as gold or silver serve as robust bulwarks against inflation. In periods of fiscal instability, when traditional paper currencies might wane, these assets usually maintain or even appreciate in value. They provide a safeguard, a type of insurance against the whims of the financial universe. However, skeptics of tangible assets draw attention to potential pitfalls. Illiquidity is a primary concern. Unlike shares or bonds, tangible assets can't be liquidated at the drop of a hat. Liquidating a property or an artwork demands time and could lead to loss if a rush sale is necessary. The cost of upkeep is another matter for consideration. Whether it's property tax for real estate, storage charges for precious metals, or restoration fees for collectibles, tangible assets can gradually dig a hole in your finances. Lastly, there's the issue of volatility. While certain tangible assets like gold might be steady, others such as real estate or collectibles may wildly swing in value. This volatility can prove perilous for investors who are not equipped for these fluctuations. As one can see, like all investments, tangible assets carry their unique set of advantages and disadvantages. The crux lies in thoroughly understanding these aspects prior to making an investment decision. In doing so, your investments are not just blind gambles, but calculated decisions perfectly aligned with your financial objectives and risk appetite. If you're finding this video helpful, remember to give it a thumbs up and hit that subscribe button. Considering investing in tangible assets, let's explore the vital factors to consider. First on the list, diversification is of paramount importance. Just as in the stock market, where the rule of thumb cautions against putting all your eggs in one basket, the same principle applies here. Such diversification should not only span various asset types, but also within the same class. For instance, one should diversify within real estate investments by considering property categories and geographical locations. Secondly, comprehending the asset is crucial. It's important to take the initiative and learn about what you're planning to invest in. If you're interested in a vintage car, knowing its make, model, year, condition, and rarity can guide your decisions and aid in evaluating potential returns. Thirdly, we cannot overlook the cost of maintenance. Tangible assets often require upkeep for value, whether it's property tax for real estate, storage expenses for precious metals, or restoration costs for collectibles. These can accumulate and should be factored into your strategy. Lastly, acknowledging the significance of liquidity is vital. Despite the security they may offer, tangible assets can be difficult to sell quickly without a price compromise. Unlike stocks and bonds, they don't provide the luxury of an instant sell with a single click. Therefore, considering the ease of converting assets into cash is necessary. To conclude, while profitable, investing such assets requires careful consideration and planning. It's imperative to assess risks and benefits, diversify, comprehend your investment, account for maintenance expenses, and consider asset liquidity. Remember, knowledge is the foundation of successful investing. In conclusion, tangible asset investment can be a fruitful endeavor if approached judiciously. We have analyzed the potential of such assets not just as a prudent investment, but also understood the risks associated with treating them as hidden liabilities. It's important to note that the key to successful investing in tangible assets is thorough research and a balanced approach. We've examined critical factors to contemplate when investing in such assets, ranging from understanding the market dynamics to assessing the asset's condition and its potential for appreciation. We've also underlined the importance of diversifying your portfolio and the need to ensure liquidity. So, as you embark on your tangible asset investment journey, weigh the benefits and drawbacks, and commit to making informed decisions. Let's continue the dialogue. What's your viewpoint on investing in tangible assets? Do you see them as a prudent investment or a potential liability? Share your thoughts in the comments below, and don't forget to like, share, and subscribe for more enlightening discussions investing.